I think we can kickstart. Welcome everyone to our third session of our MEVCA Future Readiness series, where we try to help our ecosystem, private capital markets in the Middle East, foresee and evaluate the company decisions from a right angle, trying to bring perspective from peers in the industry. For those of you who don't know me, I am Paula Mateos, Executive Director of MEVCA. Today, we will discuss the impact on valuations during market disruptions led by Lincoln International. Lincoln International is a global investment bank with 25 plus offices and 1,400 plus professionals. Its Valuations and Opinions Group is a leading independent advisor delivering 28K plus portfolio valuations annually for 225 plus alternative asset managers across diverse asset classes. They also provide transaction opinions, board advisory, and valuation support for M&A, restructuring, and regulatory purposes. We have with us today two very valuable panelists. Neil Baldwin is an MD in the Valuations and Opinions Group based in London. He has been with Lincoln International for close to 15 years now, working across North America and Europe, advising alternative investment managers and valuation of illiquid investments. Nick counsels businesses, development companies, credit opportunity funds, private equity firms, hedge funds, limited partners, and other financial institutions. Our second panelist is Srividya Gopal. She is MD and leads the Middle East practice for Lincoln's Valuation and Opinions Group. She has nearly 3 decades of valuation and transaction experience across South Asia, Southeast Asia, and Middle East. She is the chair of the Business Valuation Board of the International Valuation Standards Council, the Global Valuation Standards Setter, and member of several other boards, committees, and working groups. She is a registered chartered valuer and appraiser and RIGS qualified in the business and intangible valuation pathway. Welcome you both. Nick, Srividya, over to you.
Thank you so much, Paula. Firstly, thank you, MEVCA, for the opportunity for us to speak on this very relevant and timely topic. Really thrilled to be here. I just hope everybody is staying safe and their families are safe as well. And we really hope we see peace in the region very soon. In terms of this topic, let me just share my screen. We have put together a few slides. Just let me know if you're able to see my screen, Paula.
Yes.
Okay, great. Yeah, so the global markets have been witnessing multiple crises since the beginning of this year, actually. They call it the year of poly crisis. And in fact, some of these got escalated from even last year. It started last year and it got worse this year. And some of these are new crises. The trade policy volatility was followed by technology supply issues in the semiconductor space. And then we saw the software market volatility owing to the AI cannibalization. And then we saw overall resulting in significant market turmoil across the regions, not just here, but all over the world. This got further intensified by the geopolitical conflict in the Middle East that started end of February. And this again, we saw the impact all over, leading to energy supply disruptions, heightened inflation, and risk of recession. All these points towards continued macroeconomic volatility, slowdown in growth, and regulatory uncertainty. So what we are trying to do is we put together the webinar to primarily discuss how these developments could impact private capital valuation. That is what we do for a living. And we know that many of the members of MEVCA are also quite interested in this topic. We want to look at the critical factors investors should look in for their valuing their portfolio in times like this, specifically focusing on the topics we just spoke about, but it can be a wide range of discussion that we can have. And we want to zoom into a little more on the GCC, throw in some of the challenges for the valuers, as well as talk about some of the best practices and things that we can consider in a time like this. So as I said, we do have a few slides, but we will make sure there is ample time for questions at the end of the presentation. So we want to just talk through some of the factors that is affecting the business, zoom in a bit more into some of those factors, primarily the energy market shock, the technology imbalance and the software sell-off, and touch on the other factors, potential impact on GCC, the valuation challenges and consideration, and a quick summary. Very quickly on the factors, I think I already touched on this. On the energy market shock, we are all aware that the Strait of Hormuz has been blocked, and hence there is a significant disruption to energy supply across the world. It's not just GCC, it is actually many parts of the world which is severely impacted because of this. And then there are macroeconomic impact and market reactions. There is a domino effect affecting a plethora of industries. It's not even the energy industry, but literally every other industry that is getting impacted across the world. And also, what started off earlier in terms of the technology issues, there was a significant shortage of the hardware memory chip even last year due to this demand from the AI infrastructure. And then, end of last year, earlier this year, we saw the significant sell off on the software services side because of the AI disruption. Shifting in the valuation framework from whatever was time tested to something new, more focusing on profitability and capital efficiency. And there has been issues on the trade wars. In fact, I think March last year, same time, we were all talking about the tariffs that US imposed across the world, especially China, and how the reaction is going to be. We saw the markets go down significantly and then go up again. This year, same time, we are continuing to see those issues as well, but amplified by so many other things. Growth slowdown globally, market volatility, it's just been going up and down, monetary policy uncertainty, and also a lot of protectionism by some of the government. So lots going on actually, which is going to impact business, economies, and hence valuations. So we can just dive in a little bit deeper on this, and then I will maybe hand over to Nick. But before that, can I request you to flash the first polling question, Paula? It will be great if you could answer this. I mean, it can have more than one response. It will be great if you can answer so that we just have a better understanding of where you come from. Are you a fund manager? Are you a valuer, service provider? It will just be good to know that. So, we will perhaps give you a few seconds, and then once the answers are in, will be good to know if Paula can flash the answers as well. Paula, should we look at the responses, or are we still getting the?
We're still getting, but I think we can say that 37%, well, around 40, let's say, they're venture capital, growth capital funds. Other service providers accounts for 30%, and then they are followed by private equity late stage investors.
Okay, great. So I would imagine still more than half is going to be on the investor side, and then the other service providers who have an angle on the investor side. Maybe they're supporting the investment segment. Okay, that is great. So with that, I pass it to Nick to cover this segment. I'm happy to just move the slides, Nick, whenever you let me know.
Sounds great. And thanks, Shravidya. And thank you, Paula, as well. Happy to be here and speaking with all of you today. As Shravidya outlined, there's a lot going on, I think, in the market right now, which is why we're all convening here. I think what we'll do as a first step before we really dive into regional specific implications and or valuation considerations is zoom out a little bit and just go through some of these main themes that we're observing, that we're all observing and trying to cope with as we think through the impact on portfolio companies, private capital, investment, valuation, and performance. And so with that, Shweta, if you want to move into the first section here, we're gonna be focused a little bit to kick things off on energy and some input prices. And starting with the energy market, due to the conflict that we're currently all observing in the Middle East, we've observed basically a near stoppage of shipping trade through the Strait of Hormuz, as we all know, Shrividya just mentioned. But just to give a sense of the scale here of impact, we know it's a critical route for the transport of goods, including crude oil, liquefied natural gas, et cetera. But you can see this table here where we compare key global shipping regions, and about 20 to 30% of all global output of oil and liquefied natural gas moves through the Strait of Hormuz. So as a result of this, we all are very aware right now, but we've observed that oil prices have been increasing rather significantly, rising to over $100 per barrel. Futures are also up. One thing that's probably worth noting that's of interest is that the decline is, or the increase in the futures rather, is more in the near term, showing that the markets are still anticipating that there will be an end to the disruption here at some point in the near future. Obviously, time will tell, and there's a near daily reevaluation of this in the market based on political actions. But the point remains is that there's a severe impact to these flows, which has been driving this increase in energy prices. And if you move on to the next page, as Shrivati was mentioning earlier, this will have an impact across nearly every sector. This page and the following walk through, and I'm not going to read everything to everybody, but call out some high-level thoughts. But this walk through where we think the various impacts across industries, with both first-order impacts on as well as second-order impacts, will really be prioritized. We observe that the first-order impacts will be on industries such as transportation, logistics, chemicals, and other power-intensive industries. But depending on the length of the market disruption, as well as this period of elevated prices, there will be second-order, broader scale impacts, with higher fuel, feedstock, and power costs having an impact across nearly every sector, as was mentioned. We also will need to start to contemplate, as you think through portfolio company management, forecasting, et cetera, and investment criteria selection, is what is the potential broader impact on inflation as a result of this, and then therefore discretionary spending, which could also bleed over into a lot more consumer behavior and broader market participant behavior as well. The next page continues to highlight some of this. I think one of the main things is that if you see a common thread across these industries, where we've put in the middle column here the effect of higher energy prices, I think that it will likely be no surprise. I'm laughing because it's a bit obvious that cost pressures are going to be elevated for many, many businesses. In some instances, it's going to be dependent on the demand elasticity of the revenue and the service, right, as to how those pressures will be handled, whether that be via margin pressure at the business or higher cost pass-throughs. It's going to be mixed, as you can see, for some of these as well. We've We've also highlighted that I think why this exposure exists can be helpful for thinking through as you're evaluating your own investments and portfolios as to where's the risk for you in the supply chain. Some businesses are going to be more well insulated than others. Others are going to be higher exposed, right? It's a spectrum across the board as we think about these higher input prices. But I think the main takeaway is that this has long impacting or far-reaching implications across multiple industries. With that, Paul, I might ask you before we move on here to talk about this page 9. Well, you can go to it, Shrividya, but we might just kick off with the next polling question as well.
Already launched. Let's give a
Thank you.
couple of minutes.
Yeah, and while you're all reading this, it's going to be a bit self-explanatory, but we'd love to get a sense of what regions represent your investments and business interests, and help guide some of the comments we make, both myself and Shrividya, as we go through.
Okay, I think we have the majority of people investing in or having business interests in the UAE, GCC, broader MENA region, followed by Europe and rest of the world.
Great, thanks, Paul. That's really helpful and really in line with what our expectations were of the audience today. So that's great, and we're going to be focused a lot on those most represented regions. But I think it's worth noting about global impacts here, which is what we've tried to outline on the page that you're looking at now currently. As it will have impacts across multiple sectors, it will also have impacts across multiple regions, but they will vary to differing degrees and in different directions. Um, there any benefit from higher prices, I guess starting with the GCC here, any benefit from higher prices will need to be considered in tandem with volume impacts due to shipping disruption and other logistic disruption, as well as geopolitical risk and infrastructure damage. That might be a bit obvious, but there's two sides to the equation here. As we think about higher prices, upstream might be benefited in one hand, but we need to think about impact on the volume and supply side as well. And when you walk down this list and think about Europe, it's sometimes easy to think about Europe as one large entity, but really, similar to other parts of the globe, there will be a mixed impact across various countries depending on their reliance on imports from the region. There's likely to be an impact on inflationary pressure, though, no doubt, from the result of higher energy prices across the region. Looking at Asia, and it's a common theme across many of the countries listed here, but there's a high reliance on imported energy for many of the regions and countries listed, which will have significant cost pressures as well as big supply disruptions across the region. So not simply higher prices, but also just availability of energy, in some instances will become a focus point as well for certain types of businesses, particularly certain SMEs. The Americas could observe upstream benefits, but there will be no doubt an inflationary environment as well as a result of higher prices, and rising consumer prices could negatively impact consumer economic growth. Rather, that's probably true across the board, not just the Americas as well. So, just thinking through the regional impacts, while similar in common threads, they won't be uniform. And that's probably an important consideration for thinking about business impact across portfolios and for investment decisions. So moving to the next section, because we have a lot to cover here, we want to make sure that we're not missing other large periods or pockets of market volatility. Energy market disruption is the most volatile discussion probably day to day in the media, but very closely followed by AI and software, which is having an extreme impact on public markets as well, namely the software sector, which we've tried to illustrate here with this graph just to highlight some of the volatility that we're probably all observing as well. Here we have various software and service related indices, which have definitely had a volatile start to the year, namely really triggered by Anthropic's announcement of new updates to its agentic platform in early 2026. And you can see in the green box that's been highlighted on the page, the year-to-date performance of these indices is really down about 20%. The first three listed indices here are equity indices, and then the bottom index is actually a loan index. So the 20% is referring to public equities here. One thing that I think that will be a theme that I'll touch on a couple of pages as we go through here, through these pages, though, is that we're still really in the private markets in a period of real price discovery as we think about what is the impact to business values, investment values as a result of AI disruption. And I think if you go to the next page for video, we can kind of think through the key themes as well as market participant perspectives that are guiding some of the thoughts around this right now. I think what we've done is we've spent a lot of time, one, looking at these businesses, but also thinking about or speaking with managers for their perspective on how they're making investment decisions, portfolio monitoring, updates, et cetera. And a few things are coming out of these discussions. One, AI isn't a brand new concept. I think we all know that AI existed and was on everyone's radar prior to earlier this year, before the broader market sell-off started to occur. But we note that many investors and managers have been making investment decisions and taking AI as a significant consideration into those investment decisions over the past year to 24 months. In fact, we see it very, very prevalent now in most IC memos that we're receiving for the work we're doing in speaking with managers around underwriting theses and understanding investment cases. AI is always addressed, whether it be an opportunity, risk, or both. So many managers are saying, right, there's broader market panic or sell-off at the moment, but this is something we've been thinking about for a while. It's not brand new to us. For many, though, what I would say is the newer question is likely one of how quickly is AI technology evolving, and therefore how quickly will it require an adjustment to my perception or my business case, right? And so that could be an opportunity, but it could also be um, a demand destruction. It depends a little bit on the business, and it's going to need to be taken on a case per case. But that's really what we're finding to be the bigger question or the newer question now is how quickly will this impact the cash flows, for lack of a better word, for each of the businesses that I'm invested in. And what's probably very clear is that the near-term impact might be de minimis. I think that many managers feel that for the next year, 6 months, year and a half, 2 years, they're probably business as usual or not business as usual, and that they're going to ignore this, but more they're working through their strategic case for each of the investments they've made, which considers AI. But the real question is what will be the impact in 2, 3, 4+ years for many of these businesses, based on how they react over the coming months and year or so, and based on how quickly technology evolves. In our work thus far, and in the discussions we've been having, we find that valuations for PE businesses year to date, or privately held businesses year to date, have probably been down anywhere in a range of 5 to 15%. And it's really going to be driven by what is the perceived or expected risk, negative downside risk as a result of AI that's gonna dictate where those businesses are in that spectrum. And it's not to say everything is down. There will definitely be some AI winners as a result of the evolution in the technology, but it's definitely worth noting that that is a smaller subset of the overall broader market within the technology, software, and services specifically. This page also highlights here a few of the characteristics managers can think about in the current period as defensive software businesses or resilient businesses. I think though on the right-hand side is that, and I said it before, is that we're still really in a period of price discovery, where investment volumes in the sector have slowed. Many managers have taken a risk-off approach globally. Now, some are looking for high opportunities to make what they might think of as good buys, but I think overall volumes have really come to a halt on deal activity. And so we're still really in a price discovery mode. And on that point, the next page, Shravidya, thanks, shows a little bit about how that idea around future expectations are really driving this decline in the markets. You can see a graph here that dates back to January 2025, and there's two lines. There's the lighter blue line, which is a software index that we put together of key market participants. But then the darker blue line is what has been the next 12-month revenue growth for those same businesses on average. And if you follow the darker line, of course, there's a little bit of volatility over the past year plus, but really it's been fairly stable. That outlook for growth on revenue has remained robust. However, we've seen multiples decline rather significantly over that same period. So what that tells us is that this isn't based on near-term expectations, as I was mentioning earlier. It's really based on longer-term expectations around the impact to revenue growth for these companies. So with that, I think we can probably wrap up the macro sector with some key considerations around some other factors as well. Not that that wasn't enough for everybody to consider already, but there's other things still continuing to be a factor in the market. And namely, one is trade policy volatility and as well as protectionism pressures that come with that. I think we're all been aware that the tariff environment has been in flux for a couple of years now, and policy uncertainty there has been really complicating M&A decisions and processes for some businesses as a result. Um, we've seen that many managers are taking a view that, this is our business. We have to get on with it, and we'll continue to make investment decisions and manage global trade policy as it comes. But other managers have more taken a view that if there's going to be complex trade impacts on certain businesses, that they're just no longer interested or a buyer. So it's definitely bifurcated the market as it relates to these types of companies. And we've discussed it in the energy section as well, but inflationary environment overall will have an impact on monetary policy across the globe, which then therefore no doubt has an impact on cost of capital for businesses, their future cash flows, potential impact on business growth, and then ultimately valuations as a result of all of those factors. We've already been in an environment of highly selective asset allocation for a while now, with only the highest quality assets being considered. And this macro environment, if it persists, may only serve to really reinforce that trend. So I think with that, I'll turn it over to you, Shravidya, to focus a little bit more on the GCC as well as valuation impacts and implications.
Thank you so much, Nick. I just wanted to highlight that we value many of the investments for many of our clients on a quarterly basis and some on a monthly basis, which is why Nick was able to share some of the evaluation impacts that we are seeing between December 31st and March 31st, because we've already valued several thousands of investments for them during this period. And we are already quick to see the impact because the cadence is a lot more frequent than what you may see in certain parts of the world where it is more quarterly, half-yearly, or annual. It's just easier to understand when you do it with a more frequent cadence. So, which is why great to hear all these insights from you, Nick. So before we move on here, can I request Paula to share the third polling question?
Already launched. That's why.
Okay, great. Yeah, which industry will be most impacted in your view by the current market disruptions? Again, you can take more. Will be just great to understand your views on where you see the impact is going to be the most.
Okay, I think we've got enough answers now. The ones that are the highest are energy and utilities, hospitality, leisure and entertainment, transportation, and real estate.
Okay. Yeah, I think it kind of aligns with what we were seeing as well in the earlier slide, and definitely for the MENA region. Thank you for that. Okay, great. So, we just briefly talk about the potential impacts in the GCC and the broader MENA region. Firstly, as Nick outlined so far, the impact of the market disruptions are felt globally, with different regions facing a variety of issues. More specifically in GCC and MENA, there is a higher risk perception and hence more caution and selectivity on the transactions, especially. Also, as we witnessed during COVID initially, there is an expectation of transactions being put on hold for the short term, which could either result in delays and hence lower volume for this year, or it could result in a spurt in the medium term due to the pent-up demand. Kind of what we saw during COVID, there was no activity for some time, then suddenly we saw a very, very significant increase in activity. There could be some shifts in allocation to larger sponsor-backed rounds from very early stage rounds. It was also in line with what Nick mentioned globally. We could see similar trends here as well. But this would also depend on the sector focus. We could always find winners in the early stage, which are kind of, sector agnostic, crisis agnostic. There could be some winners which is doing much better than the others in the crisis period. The good news is that GCC continues to benefit from a strong momentum in terms of medium to long-term fundamentals, supported by diversification and capital availability. Many of our funds continue to invest globally as well as in GCC. And compared to many other countries which are primarily dependent on, overseas LPs funding them, here I think it's a very, very good balance with a lot of capital available locally. The sector focus will continue to align with regional focus, potentially with some changes brought in because of the current dynamics. And the exit strategies will have to diversify. I think we started seeing this more recently in the region, even before the crisis. With the crisis, it's going to become even more prominent that there has to be more structured routes. There could be secondaries, there could be trade sales, which has to kind of complement the traditional IPO in terms of an exit. So with that, maybe you can, show the last polling question, Paula. I think we have the fourth and the last one. It will be great if you can just put that on.
Yeah.
Okay, so this is, I'm sure everybody is focused on valuation in the group, or almost everybody is. It'll be great to understand what are the key challenges you're facing, whether it is uncertainty in market outlook, disruption to business models in the near future, ability to gauge the risk, data point availability, volatility in the public market. Clearly, public market has been super volatile. Unclear on methodologies and adjustments or anything else. Will be just good to see maybe the top 3 or 4 key issues that you're facing today on the valuation side or expect to for the first quarter valuations.
Okay, so the top one is uncertainty in market outlook, followed by disruption to business models beyond near future, and then ability to gauge investment risk in the near term.
Okay, perfect. That's very insightful. Thank you, Paula. Okay, great. So it kind of brings us to a nice segue into the next topic, which is valuation challenges and consideration. Clearly, the kind of challenges we see are unpredictability, credibility of information provided, history. We always look at history when we want to do valuation analysis. How much can we use history in terms of does it really reflect the future? How much can you rely on the budgets and forecasts? And then there is also a lot of disruption in terms of volatility, dramatic changes. There is one event, the US president makes an announcement, the markets go one way, and then the next day he says something else, the markets go the other way. So each of these small things kind of trigger the market to go one way or the other, all of which kind of impacts valuation because you can't ignore the public market when you do private investment valuation. To some extent, it has to be considered. And then sometimes the traditional business models kind of just go away. They are no longer relevant in a current situation. Something that was doing so well might have to be relooked at. For example, that is a question for maybe certain types of the software services industry or any other industry that is facing the crisis right now. Long-term price erosion, is that a possibility? Yes. Risk perception, obsolescence in terms of valuation methodologies itself. We relied on maybe certain recent transaction metrics. Today, can you really look at recent transactions that happened before the crisis and before all these events happened? They may no longer be relevant. So we need to think about what is most relevant today in terms of methodologies, reliance and backlash. There could be, post-factor litigation and things like that. Data availability is not really great, especially in situation like this. So in generally, valuation requires greater judgment as traditional methodologies are tested by volatility and structural changes. And there is clearly more uncertainty, possibly a bit more emphasis on scenario analysis and stress testing, because that's really the best thing that one can do right now. Try and understand, okay, these are the possible scenarios, and then what is the probability of each of these, and then how do I look at the valuation from that perspective? It is one of the considerations to think about when we do the valuation. And more specifically, I think Nick already covered some of these. When we look at anything around energy impact, the key questions to ask is assess the exposure to energy costs for that specific business or industry or company. It could be it could include hedging, inventory levels, the reliance on the supply, ability to pass some of these higher costs to customers or not. Supply chain flexibility, are there any alternate sources possible for them? I hear that there is not enough LPG supply in India, so everyone's gone and bought those induction cookers which can be used with electricity. But then there obviously will be other impacts. This is not a permanent solution, but then there are solutions, at least for the near term. And on the software side, again, Nick mentioned most of these. Whether evaluate the AI disruption risk and durability of revenues, each business could be different. In general, you may say that there is going to be an impact, possibly a negative impact, but again, some impact could be positive as well. Look at it more, long-term switching cost. What are the revenues which get disrupted because of AI, and what are those which are a little more long-term, whether they are being paid by the seat or whether the revenues are outcome-based. And in general, of course, the thing to understand is valuations are dynamic with multiple compressions driven by uncertainty. Hence, sometimes we need to look at potentially long-term performance. And then sometimes you try to say, okay, things are not good. I will Nick says 5 to 15% has been the reduction, so I will just reduce all my valuations by 5 to 15% because that's a global data point. Again, that really does not work, because one has to look at it on a case to case basis on what is applicable in that business and in that sector and in that industry, and hence try and see what is the reduction. The reduction is never a percentage. The percentage is derived from so many other assumptions rather than it being a key input to the valuation. And of course, greater analysis on scenario, greater emphasis on scenarios, downside protection, and things like that. Overall, the focus should be on resilience, visibility, and adaptability over historical performance. Can't just look at historical performance and use it to predict the future projections. Prioritize businesses with purchasing power and incorporate downside, upside, and those kind of things into the analysis. And I also wanted to bring in some specific guidance from standard setters. It's not just Nick and I or even Lincoln coming and saying these things. There are standards for valuations, and they continuously keep giving guidance on what needs to be done. And there is already enough guidance on what happens during market disruptions, during uncertainties, how we need to look at it. And I have taken these from some of the key standards like International Private Equity Venture Capital Guideline, International Valuation Standards, and others. And typically what you would determine is the fair value for every quarter for your internal reporting, LP reporting, strategic analysis, financial reporting, etc. And it clearly says that fair value is not a fire sale. Just because there is a disruption, it doesn't mean that you need to mark it down, assuming that you're just going to sell it as a fire sale. It is still the amount that would be received in an orderly transaction based on market participant assumption. I think that is what is really critical here. And valuation is very dynamic. The more the cadence we have, the better. And again, it's not about predicting we are not predictors. We can't say, oh, the war is going to end on this date, and after that, it's going to take so many days for the energy prices to change. It's not for us to do that, but we need to rely on whatever is known and knowable as of that valuation date versus taking something which is post facto. This is a very critical assumption on what is known and knowable as of the valuation date. Care should be taken not to double dip. What it means is we think the future is going to be bleaker than what we imagine. So, reduce the revenues, reduce the profits, everything. And also put in an additional risk in a discount factor, increase the discount factor. So it's a double whammy that should be avoided at any cost because you are just one or the other and not both. And again, keep going back to this market participant view. Typically, a market participant, if there is a higher uncertainty, will think of it as a higher risk and could expect a higher return. It's a very basic assumption. What is that higher uncertainty? What is that higher return is something that has to be determined on a case-to-case basis. And look at the impact on the portfolio companies, revenue, supply chain, and again, for limited partners, fund of funds, sovereign wealth funds, all of whom invest in other funds, one of the critical things is they typically rely on what is given to them by the general partner, which could be a quarter old, which could be 6 months old. In situations like this, they need to put in a lot more analysis to see if the NAV that they're getting, which is 3 months old, is still useful today. In a situation like this, clearly what was given to them in December can't be relied on as of 31st March. They need to do an additional analysis to see where the NAV should be. Focus on best practices, governance, and transparency. So these are the very important things. And very quickly on the summary, one thing to think about and gives us some kind of a consolation is that this is not the first time we are facing crisis. We've seen crisis. I mean, there was a time traditionally where we had long stable periods, smaller recessions, and longer growth periods, and then again long stable periods. Those things are gone. The last many years, we've seen much faster changes in the market, whether it is because of the global financial crisis, oil market slump, COVID. COVID taught us a lot of lessons, and then the Russia-Ukraine war, and now the Middle East crisis. So at every point, there has been a significant dramatic fall in the market, but it kind of picks up soon after that. So there is some hope, and we can take some lessons from these markets to understand how we can cope and how we can plan. Everything is not the same. Of course, today we thought COVID was unprecedented. That was the word that was used for COVID. But today, I think it's a lot worse in a way. So every crisis is different, but we can always take some lessons from the previous crisis to see how it is. Finally, of course, accept the new reality, refocus the mindset, stay updated and adaptive. I think that is the most important. Ultimately, consistency, transparency, and methodology rigor are very critical in a volatile market. So that is what we have. Happy to move on to the Q&A.
Yeah.
Let me stop sharing. Perhaps Paula will be easier.
Yes, please.
Yeah.
Thank you both for this insightful session with very useful data points. As you said, let's move now to the Q&A section. The attendees can start typing now the questions. I have the first question for Nick. Given the volatility in the public market, do we need to have the same adjustment to private investments?
Yeah, it's kind of a common question no matter what's happening out in the market, right? Is how do we think about public market inputs as it relates to private capital or private businesses? And I think the question there is same, right? The same adjustment? No, probably not. In fact, what we've observed is it's going to depend on where in the market you are, what type of life cycle of business that you're investing into, what region, what industry, et cetera. But I think one common thread that we continue to observe is when you monitor private capital activity. So if you think about implied M&A activity multiples, whether it's revenue, EBITDA, or something else, you can always observe that the way private investors behave is never one for one in lockstep with public markets. And we've been able to observe that at Lincoln, we have a private market index actually that we publish quarterly, and that shows the valuations of private businesses, a lot of sponsor-backed private equity businesses in that instance, and you can monitor the volatility of those valuations of those businesses, which will be really rooted in transaction activity against broad public market sectors. And we find that in general, over a long term, the volatility for private asset valuations tends to be around 30 to 40% that of the public markets. Now, that's not to say, as a rule of thumb, just take 30% of the volatility in the market. It's always going to vary based on company specific factors, what's actually happening. But I think it's really important that you consider a variety of market input data when thinking about valuations and not only just public equities, for example. There, you have to think about the market participant point of view. If I'm likely to sell in a private market, how is the private market behaving right now? And it may or may not be the same as the public markets. And so it's something to think about. It's hard to just say what the adjustment should be as a blanket statement, but we do find in general that it's not in lockstep with public markets, and you want to think more critically around what are private market participants doing.
Thank you. Thank you so much. Srividya, what are the specific challenges and considerations for early stage investment valuations as of Q1 26?
Great question. We feel that, one of the things I mentioned earlier is the recent transaction price, especially those negotiated a few months back before the crisis, may not be necessarily indicative of fair value as of March 31st. That's something we look at quite a bit to do valuation in terms of the recent transaction price. And many of the assumptions around their business models and business plans might have changed. Using other industry transaction multiples may be a challenge for the same reason. And it also raises a question of how much one can rely on public market data given the fluctuation and choosing the right comparables too. Some consideration to think about is update the assumptions around the projections, milestones, exit timings, etc. before you embark on evaluation as of 31st March. Also to have a more frequent cadence, which I mentioned, to review these assumptions as well and the valuation. For early stage, specifically focus on impact on cash burn. These are questions I will ask if I am doing evaluation as of 31st March. What is the cash burn? What is the cash runway? Is there a need for new funding round? Timing of the same and those kind of things that's going to impact running of the business. For some businesses, there may be a need to pivot the strategy if the original concept is impacted because of the crisis. And again, we might consider some kind of a scenario building if it is helpful to get a much better or a more visible outcome in those early stage startups.
Thank you. Someone in the audience is asking, how will the crisis, if prolonged, will impact private equity exits?
Free to take a stab at this, Shruti, and then jump in if you have other thoughts. But it's probably hard to say. I know that's not, I don't mean that as a cop out. What I can say though is that private equity hold periods have already been extended and are longer than what they have been historically. So this is a phenomenon in terms of exits and timeline to exits that private equity has already been managing. There's a few thoughts that come to mind. One will be the quality of the assets will dictate some of their exit timeline, probably in the near term. As businesses are able to pivot and react to the macroeconomic uncertainty, those that are well managed and performing well will find an easier path to exit. So I think asset allocation and selection across managers will dictate that. It won't be uniform across every manager. That being said, LPs are ultimately probably going to be driving that discussion a little bit more with their managers they're invested with as hold periods continue to extend in periods of market uncertainty. We know managers don't want to sell unless they think it's, just the best quality asset and they know that no matter what, they'll get the price they want. So market uncertainty only reduces prices, frankly. And so what you could probably expect is more hold periods to extend, but that's going to be really at the mercy of LPs allowing that. So it will be a discussion between LPs and GPs around acceptable levels for exits and return profiles. And then it's not the question that was asked per se, but I think it's a relevant kind of tangential point is we've seen a real explosion in secondaries markets over the past few years as well. And so that might alleviate some of the pressure on GPs if LPs are able to find liquidity solutions other than individual asset exits. So I think it's a lot of factors to consider. I don't have a crystal ball myself, but I do think that uncertainty will probably extend hold times, which means further or reduced exits. But it's going to be really this balance of what LPs can find and tolerate in terms of liquidity in their own hold periods.
Yeah, I think Nick answered it already. Yeah.
Perfect. Next question is, in periods of geopolitical shocks and energy disruption, which valuation inputs tend to become most unreliable first?
From a real
Okay.
academic and theoretic point of view, if you're talking about like a WACC buildup or something like that for a discount rate, what we find is that you tend to use a lot of normalized levels, right? And so these can be like long-term equity risk premiums, for example, or normalized risk-free rates or normalized costs of capital. What becomes very difficult in these periods of really large market volatility is that what is the idea of what is normalized. And so what you might find is that some of those key inputs, that's a real technical answer I'm giving right now, but some of those key inputs probably need to be reevaluated. In rising interest rate environment, maybe the long-term average or some normalized view is not relevant. In a given period. Same with equity risk premiums when there's extraordinary volatility that is maybe expected to continue. Those long-term normalized risk premium might not be appropriate in the current environment. But I think that another key input that might become outdated very quickly is the cash flows themselves for some of these businesses, right? Business plans are not reevaluated day to day, month to month in most instances by management. They're just trying to get on with doing the job. And of course, reacting to the market, but not necessarily reforecasting in a bottoms-up approach on some sort of regular cadence. So you have to think about the cash flows and then the discount rate in the case of a DCF in tandem. And if you're not able to update cash flows, you might want to be updating your risk profile. Those cash flows, maybe they're higher risk now than they used to be because you don't have them risk adjusted quite yet. So those are things that come to mind right away.
Perfect. Srividya, do you want to add something to that?
No, I would say that you question everything. I would question everything, and I would relook at everything to see if it is relevant for today's valuations. Right? I think Nick has already pointed out many of those examples, so I think we are good.
Perfect. Okay, next question is, based on your analysis, which industries do you expect to be most impacted in the GCC?
Okay, right now we are primarily seeing airline and transportation as one of those that are impacted. But I think in the long run, there could be other things. It could be the industrial, it could be manufacturing. I mean, hospitality, I think there's going to be a significant impact on hospitality, entertainment, media, and a lot of things which depends on people coming in on a regular basis. So I think these are the main things. I think every industry will see some impact or the other. But this is what we primarily see on the Middle East, on the GCC side, which is slightly different from what you may see for other countries.
Okay.
And sorry, this is just a crisis. Also, we spoke about software. That's a different point altogether. So definitely, I think we are going to see some impact in the medium to long term on the software services industry as well.
Perfect. Thank you. Prince Sangtani says, you mentioned the recent transactions are not comparable enough. Should we straight apply a discount to the multiples or any other way you would like to suggest?
Yeah, I would say please do not apply a straight discount to the multiple. That's something you should never do. How do you justify what discount you apply to the multiple? See, when I said transactions may not be relevant, it doesn't mean they are not relevant. It's important for us to try and understand what was the basis on which those transactions were made. if those bases still are, applicable and reliable in today's context. In some industries, it is possible. In other industries, potentially not. In most industries, you would need to question that and then see if, okay, if the transaction, for example, was determined as of November in a specific industry, and then the markets are moved from X to X minus 5% between, say, November and December or December and March, you may still look at those market changes, number one, and you may look at any fundamental changes in the business itself, number two. These are the two things you would potentially put in as an adjustment. And when I say fundamental changes, it is not just a question of the revenue adjustment, it is also the sustainable revenue and the sustainable profits that the business could have given the current situation. So these are the adjustments that we need to put through on a case-to-case basis, which will determine the discount rather than use the discount as an assumption to determine the value.
Perfect. Next question. How will energy costs change in the GCC given that oil supply is not that much affected internally?
How will the cost change in GCC? I don't know right now. I think the cost has not been changing too much because there is a supply given and there is no scarcity, unlike other places where apparently people are queuing up long lines to fill their petrol and stuff. So far, we have not seen it. But again, we live in a global world. It's very difficult for me to say how things will change. I don't know if Nick has any additional thoughts.
Just going to just extrapolate on that idea around it's a global economy and this is a global raw material input cost, right? So localized pricing might vary from region to region as we were talking through earlier, but I think the inflationary impact globally will impact trade overall, right? And so there's knock-on impacts or secondary or tertiary impacts for regions based on what it is that in the supply chain you sit for various industries. So whilst one price might not be changing for one item in one area, I think what we're going to see is that there's costs rising globally as an input for most manufacturers and producers, and then there's going to be knock-on global impacts broader.
Yeah, it's going to be a snowballing effect, a domino effect on many things, which we can't even think about right now.
Yeah. Okay, and how do you assume country risk premium?
Okay, see, country risk premium depends on a whole lot of things, especially how strong the sovereign, bonds are. There have been studies that have been released. In fact, recently I saw a study which was talking about the change in the country risk premium between December and March. And at least for the GCC countries, it is mostly in percentage points. Like I think I saw UAE was like 0.3% increase or something like that. And Egypt was 1%. So in general, it was all, less than 1%, especially because the GCC sovereign countries are fairly strong and the default rates are considered to be very, very low. I would say, I would imagine the question is for the GCC, but of course, if it goes beyond, you need to clearly look at how all these problems are going to impact other countries, how it's going to impact the, sovereignty of their bonds and things like that, and then determine the country risk premium. It's all about the risk perception of the sovereign.
Perfect. Given the present situation, should an early stage investor consider pausing investment activities?
It's that's going to be in the eye of every market participant, right? I think these differences of opinion on what something is worth is what makes a market right now. And of course, I think that when you talk to a lot of market participants right now, there's been a general sense of risk off, meaning slowing of deployment. But I don't think that anyone is saying that they're closed for business. I think that part of being an investor is navigating broader market volatility as well and still observing and finding buying opportunities, which I'm sure is what you mean by that. I think that it's just probably around being selective and really taking a point of view on where you can invest. We're not here to provide investment advice clearly, but I just want to make the comment that we can observe lots of different market participants through different periods of market volatility, and it's very rare that everyone just stops.
Perfect. I think we are just in time. So if anyone has any other questions, just send them to us. So they will be happy to answer them. Srivija, Nick, thank you so much for this very insightful conversation. It has been fantastic. I think it's been really valuable in these uncertain times to have a sense of what to do, what's happening, and how to do proper valuations. So, thank you so
Thank
much
you.
and stay safe, everyone.
Thank you so
Bye.
much, dear
Bye
Thank
friend.
bye.
you.
Bye.